Hey guys, how we doing today? Today we're going to be talking about drip. What is a drip? Now, we might have two different explanations or definitions of drip, but let's talk about it. And let's talk about how drip can actually make you some money. So what is a drip? The word drip is an acronym for Dividend Reinvestment Plan. But drip also happens to describe the way the plan works. With drips, the cash dividends that an investor receives from a company are reinvested to purchase more stock, making the investment in the company grow little by little. So here's how drips actually work. A dividend is a reward to shareholders, which can come in the form of a cash payment as paid via a check or a direct deposit to investors. Drips allow investors the choice to reinvest the cash dividend and buy shares of the company's stock. However, the shares are bought from the company directly. Many companies offer shareholders the option to reinvest the cash amount of issued dividends into additional shares through a drip. Since these shares usually come from the company's own reserve, they are now offered through the stock exchange. So let's get into fractional shares. The dripping of dividends is not limited to whole shares, which makes these plans somewhat unique. The corporation keeps detailed records of share ownership percentages. For example, let's say that the TSJ Sports conglomerate paid a $10 dividend on a stock that traded at $100 per share. Every time there was a dividend payment, investors within the drip plan would receive 1/10 of a share. So what's the benefit of drips? Drips offer a number of benefits for both the investors buying the shares with their cash dividends and the companies offering drip programs. The benefits to investors are that drips use a technique called dollar cost averaging, intended to average out the price at which you buy a stock as it moves up or down over a long period. You are never buying the stock right at its peak or at its low end with dollar cost averaging. Company-operated drips are popular with shareholders as a lower-cost option to accumulate additional shares. There are often no commissions or brokerage fees involved. Many companies offer shares at a discount through the drip ranging from 3 to 5% off the current share price. The price discount combined with no trading commissions allow investors to lower their cost basis for owning a company share. As a result, drips can help investors save money on buying additional shares of stock versus had they just bought them on the open market where they have to maybe pay a fee. Benefits to companies is that companies who offer these drip programs receive investment dollars or capital from their shareholders. Companies can use that capital to reinvest right back into their company. Shareholders or investors that are part of a company's drip program are less likely to sell their shares if the company has one bad earnings report or if the overall market declines. In other words, the investors that are engaged in the drip program are typically the long-term investors for this specific company. There are a few special considerations to take though. It's important to note that the cash dividends that are reinvested into drips are still considered taxable income by the IRS, and they definitely must be reported. Please consult a tax professional for those specific tax ramifications depending on your specific situation. Also, when investors who purchase shares via a drip program want to then sell their shares, they must sell them back to the company directly. In other words, the shares are not sold on the open market by a broker like Public or Robinhood. Instead, a request to sell the shares must be made with the company, whereby the company will in turn redeem the shares at the prevailing stock price. So there are definitely a few takeaways to take from this. A DRIP is a dividend reinvestment plan whereby cash dividends are reinvested to purchase more stock in the company. DRIPs use a technique called dollar cost averaging, intended to average out the price at which you buy stock as it moves up or down. And lastly, DRIPs help investors accumulate additional shares at a lower cost since there are no commissions or brokerage fees. Really hope this video helped you guys. I know with me getting into dividend stocks and just trying to learn more about that, this is exactly the information that I needed to research and put out to you guys so you guys know what to look at when you're looking for dividend stocks. Do you guys have any experience with drips? Let me know. And definitely be sure to check our Instagram page at Finance for Dummies. We would love to see you guys over there. Comment, like a few posts. I love to see it. All right, guys. See you on the next one.